I don't care if it's gold. I don't care if it's Bitcoin. I don't care if it's Fartcoin. These things don't have earnings. It is supply and demand. You have to rely on more people wanting to buy it than sell it for the price to go up. It has nothing to do with earnings, which is why you see these fluctuations, because basically everybody is just guessing and betting.
Welcome back to another episode of Off the Wall. Markets are moving fast, and like always, we're here to help you stay ahead. I'm Nate Tonsager, joined as always again by Monument CEO and co-founder Dave. Dave, how are you?
God, I'm good. The year's half over.
It
It's
is.
July. It's July 8th.
It is.
It's just, I'm lucky I have my Christmas tree down right now. So, this year has just flown by, and it's hard to believe that we've had a whole first half we can talk about, end of the second quarter, however you look at it. But yeah, it's been crazy.
It has. It's been a historic year for many reasons. I'm wearing my Knicks garb today because, first championship in 53 years, and living on Long Island, it was nuts in the city. I had friends saying they were staying out till 4 a.m. the night they won the championship. There's pop-up stores at the local gas stations, like you're down in, Times Square, that are selling championships jersey, even all the way out here on Long Island. It's been a wild first half.
It's great. It's great for the city. It's exciting. I'm happy for everybody in New York who's a Knicks fan.
Yeah, and I'm not. I am a fair weather fan by nature because I didn't grow up here, but man, I'll jump on that bandwagon because it was fun.
Yeah. If DC has some good teams coming up here in the future, I'll jump on the bandwagon too. So, but hey, college football is like 60 days away, so that's really what I'm kind of waiting on.
I was going to say, I knew where your mind was, and it wasn't on the NBA championship.
It's right.
On the upcoming college football season. But
exactly. So
before we get that, like you said, it's the end of Q2, and it's not just been a historic year for sports franchises, but also for the markets in a lot of ways. And I know we'll go down some rabbit holes, but we're here to do our quarterly market review. Like you said, recording this on July 8th, and, we each have kind of what is our most surprising insight from the past quarter. But I think before we get to that, a good place to start is just kind of level set. So, Dave, can you run down some of the big statistics maybe from the first half of the year, I guess?
Yeah, well, I'm going to start off with the second half of the year and then blend it into some first half stuff. So I'll make a distinction there. But I'll start with big size and style stuff. And I'm going to come back to this a little later from now. But what was interesting was that, the emerging markets for the second quarter were the number one performing size and style class. If you use the EEM Echo Mike ETF, up 21.07% in the second half. I'm sorry, in Q2.
And just in the quarter.
Just in the quarter. And I don't think a ton of people are talking about that. I don't think a ton of people are talking about how the small caps were up almost 20%. So, the Q2 26 was interesting to me from that perspective because it wasn't just the big large cap tech names. The SPY for the quarter up 15%, mid caps were up 14%. But also interesting to me was that the equal weight, the RSP, the ETF, you just track the RSP for the equal weight S&P 500 was up, I'm going to round to 11.3%. So what that tells me is that there was a lot more participating in this market than just some sort of second quarter rally of the Mag 7s, which I know we're going to get into that some more too, but really kind of interesting there. And commodities down, the DJP down 9.2% second quarter. But if you look back to the first quarter, it was the number one performing size and style indice, up 28%. So big, from first to worst, pretty fast there over a quarter. So that was pretty interesting to me. And then if you look over at the individual sectors of the S&P 500, in the first quarter, we had energy was up 38%. First quarter up 38%. And then again, from first to worst was down 12.69% in the second quarter. So a big fall from grace there for both the commodity index and the energy index. In the second quarter of 2026, there was just this amazing rebound in the technology sector, up 43.5%. That had a lot to do with the fact that the technology sector was down a lot, like 2 days before the end of the first quarter. So a lot of that was just, the coming off the very bottom coinciding with the very beginning of Q2. But still, the S&P 500 up 1 or 2%, depending on how you round there on that. But the industrial sector did really well, up 14%, and the financial sector, which is just volatile in my mind, not always, but it just seems like a volatile sector for us, up 9%. So, and again, the energy sector went from being up, let me look over here, 38% in the first quarter to being down almost 13% in the second quarter. So some big changes there. And then the communication sector, which I always think about being somewhat linked a little bit ish, was down 3% for the second quarter when the tech was up 43. So like some big disconnect there between the communication sector and the technology sector. I found that to be pretty interesting. But if now I'm going to talk about the first half of 2026, the S&P 500 closed at 24 all-time highs over the course of the first half of the year. And really, this was a function of just S&P 500 earnings, right? Which are now expected to increase by like 24% just in this calendar year. And it's really interesting to me because we've never really seen earnings growth this high outside of a post-recessionary rebound. I know it sounds like blah, 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 but basically coming off of a recession, you get that big rebound. That's really what I'm saying there. And this is really an unprecedented boom driven by massive earnings per share gains in big tech. We talked about that in an earlier podcast too, but the bond market has really been the interesting silent killer since the U.S. bond market, measured by the Bloomberg U.S. Ag Bond Index. It's been in a drawdown for 71 months now, which is the longest drawdown in history for that bond index. And of course, no discussion would be complete about any sort of quarterly recap, first half recap, without talking about digital assets and physical gold. In 2024, man, Bitcoin was like the best performing major asset class. It was up 121%, right? And gold was one of the best performing major asset classes in 2025, up 64%. 2024, Bitcoin up 121%. And then in 2025, gold is the best performing major asset class of all of them, up 64%. Okay, in comes 2026. Wah, wah. Bitcoin down 31% and gold is down 7%. Those are the two worst performing major asset classes for 2026. So just interesting. But that small cap flying under the radar for the first half of 2026, up 22.6%, while Bitcoin, which is talked about incessantly, daily, hourly, is down 31%. So here you've got small caps, which you may find the occasional talking head on CNBC talking about, but you're certainly not seeing a whole bunch of headlines on it. Up 22.6%. And then Bitcoin, like I said, just you can't turn the TV on without having somebody mention it within the first 30 seconds, is down 31%. That's a pretty big disparity between asset classes.
Yeah, I think Bitcoin too is the more interesting one because for so long, so many people assume that, again, digital gold, right? It's going to be a store of value. It's going to be currency, even cryptocurrency. And a big thing with currency is that, yes, it fluctuates in value, but you have some faith that it's going to be a relatively stable trade. You can't wake up one morning and your dollar value is, down 30%. Now, Bitcoin declines didn't happen overnight, but we've always said it. This isn't a currency. It's a digital trading asset that is really based on risk sentiment, and it's delinked from risk sentiment. Risk on, again, tech, all those areas that were so high flying in the first half, Bitcoin hasn't been able to keep up. And I think it's because a lot of that adoption story of, institutional investors, there's a company out there called MicroStrategy, which is a publicly traded company that their whole business model was buy Bitcoin and hold it forever. Well, now they're having to sell it because, again, the price has just come down so much that in order for them to meet payouts to investors, they have to sell. There's a lot of headwinds out there for Bitcoin specifically that it's going to be pretty hard for people to overcome. And I think what's even more interesting as we look into the future is digital currencies, but from central banks. So no longer are digital currencies like Ethereum, Bitcoin going to be run by these private entities, private markets. your European Union is saying a digital euro is going to be starting beta tests in about a year or two, and they expect it to be fully live by 2030. China's doing the same thing.
I'll say this again. You and I have both said it a number of different ways, if not the same way. I don't care if it's gold. I don't care if it's Bitcoin. I don't care if it's fart coin. These things don't have earnings. It is supply and demand. You have to rely on more people wanting to buy it than sell it for the price to go up. It has nothing to do with earnings, which is why you see these fluctuations, because basically everybody is just guessing and betting. Fine. That's great. But when you have 24 all-time highs in the first half of 2026,
Yeah.
and that's a function of the S&P 500 earnings expecting to go up by 24% this calendar year, you're just never going to convince me that those things are anything more than a bet, a speculation, whereas I can point to individual securities and be like, earnings are increasing. And
Yeah.
the price of a stock is always a function of how much money it's making. So, hey, if you're in Fartcoin, Bitcoin, gold, any of those things, whatever. I'm not saying it's right or wrong. I'm just saying make sure you understand what you own and why you own it and what it is subjected to, because it certainly isn't a function of increasing earnings by 24% in the calendar year.
Yeah. And I think
end of rant. End of my rant.
Well, and the increasing earnings is such a key part of this market right now, because you're hearing a lot of commentary out there about how overvalued that market is. You're getting some financial market and celebrities, I'll put that word in air quotes, coming out and saying the market is so expensive. The market is so concentrated in a handful of tech names. Well, first off, around the valuations, yeah, the market might be pretty pricey, but you can measure that in a variety of ways. There's no one way to measure valuation. It's all about collectively looking at different measures and what is the whole picture telling you. So while some people look at just price to earnings ratios, how much are you paying for $1 of a company's earnings? One I really like to look at is called the price to earnings to growth ratio, because I'll pay more for $1 of earnings if they're very strong earnings growth that are supporting these valuations. And so that ratio, the price to earnings to growth, the PEG ratio, PEG, that is a little bit above the 20-year average for the S&P 500, but not significantly. The 20-year average is 1.2. We're at like a 1.3. So yes, the market might be looking expensive if you look at some measures, but there's so much earnings growth to support it. Is it really the most overvalued market? I mean, I personally don't think so, because you have the earnings growth.
Yeah.
And that's the key story. And I think the second piece of this is the concentration, which you kind of, I think, touched on, Dave, a little bit with the metrics of what's done well and what hasn't done well. If we're looking just at the second quarter, a big theme of Q2 2026 was rotation. It was the Magnificent Seven names, which have carried the market for years. Think about it, your NVIDIAs, your Amazons, your Apples, your Microsofts. Those companies are struggling right now. Now, it doesn't mean they're down necessarily. Some of them are down more than others, but as a group, they've been very much an underperformer compared to the S&P 500 and compared to, you mentioned it, ticker RSP, the equal weighted S&P 500, which, as we've talked about before, is a better kind of proxy for the average stock in the market versus being more heavily favored towards the largest companies like the regular S&P 500 is.
Right.
That's really healthy to see rotations like this of your previous leaders start slowing down, but they're not dragging the rest of the market down with it. Small caps, the average companies, some of those sectors that are less loved or have been less loved are finally participating. That's a really good. Yeah, it's a great thing. But that's where I think our process here of investing in Monument, which is a very active approach, is so beneficial. It's not committed to just holding technology forever and saying, it'll be the best thing. It'll come back. It's actively trying to navigate these kind of rotations to capture the longer term trends.
Yeah. And later on in this episode, I'm going to talk about my observation on diversification, but I don't want to jump into that yet, because I know you want to talk about Mag 7 stuff.
Yeah. I think kind of just that point is, the Mag 7, looking at, there's an ETF that you can buy that'll give you exposure to all 7 of these names. In 2024, it was up 64%. 2025, it was up 23%. As of year to date, so yesterday, so again, about a little bit into July, it's basically flat. And you gave some of the statistics around where the S&P 500 is. where that equal weighted is, up double digits.
Yeah. And not only that, Nate, but like what'd you say it was up 46 basis points? What was the,
Yeah, 0.5%, let's call it.
half a
Yep.
percent? Okay, let's call it half. Let's do some Dave Armstrong rounding, right? Half a percentage point. It's up 0.5%. Do you know what the return of, and the ETF that you mentioned is MAGS MAGS.
Yep.
Do you know what MAGS was trading at on the end of the second quarter, on the last day of June?
Oof. I would think it was actually probably negative.
It was down 2.5%.
So there you go. I think it's people are saying it's a very concentrated market, and it was. But what's really important again is even though those AI-based large cap growth companies are facing headwinds, it's important to look at the rest of the market and realize a good percentage of stocks, to your point, are setting new highs. The market itself had 24. Well, right now, 68% of the stocks that are listed on the New York Stock Exchange, 68% of all those stocks are setting new highs. Right. 58% are trading above their kind of short-term trend line, which people like to call the 50-day moving average. What is the average of the stock's price over the past 50 days? If you're above that line and you're setting new highs, that's a strong market. And I think that's a big thing people are struggling with. Maybe something we'll have to get into in our next AMA, because I think we're getting a lot of questions about that. The market is strong, even though it may not feel like it because of all the geopolitical volatility that happened over the past quarter. To your point, it was kind of the tale of two quarters in the first half of the year, with first quarter was dominated by rising tensions and geopolitical. Oil did well, other parts of the market didn't. That flipped in Q2 on its head. But that doesn't mean that still you're seeing strong underlying measures of strength across the market. So, I'm actually honestly happy that these big companies aren't doing so well, but I'm only happy because the rest of the market is helping still support all these new highs that you're seeing.
Right. And you mentioned energy. I mean, that goes back to when I was a few minutes ago just talking about the difference between the first quarter and the second quarter of this year, where energy, the XLE ETF, was up, I'm just going to call it 38% in the first quarter. And it was as the number one performing sector of the S&P 500. And then second quarter, it went from, first to worst, it was down 13%. So that, it just kind of goes to, I am punctuating your point.
Yeah. And I think, again, we can kind of, move on to, why is it important to have a kind of diversified strategy as we look into maybe, what happened, but also what could happen in the future too, for the rest of the year.
Right.
I think it's important that we keep an eye looking at, what tech is going to be moving up and down. It's going to be a volatile market. We have midterms coming up, but really, again, that's why you need diversification in a portfolio.
Yeah. But you had some other interesting statistics that we were talking about yesterday about the broadening out of the rally with the percentage of stocks listed on the New York Stock Exchange that are setting new highs. But what were some of those statistics you were throwing out yesterday? I can't remember.
Yeah, the one that I really like to call out is, again, the one we said just a few minutes ago here, is that 68% of stocks on the New York Stock Exchange are setting new highs right now.
Yeah, that's what it was. Right.
That's the healthy sign, because you want stocks to continually be setting new highs as they grow. And again, like we talked about with the trend line, about 58% of stocks are above that short-term trend. So all of that data is really showing that, yes, AI maybe is a big piece of the market, it started to slow down in some pieces of it, but the rest of the market still has the strength, still has earnings growth. Not all the earnings growth is coming from the 5 or 6 companies. A portion of it is. I'm not going to deny that. A good portion is coming from these companies that are really capitalizing on some of the AI trends, but other places are still doing well and have been for a lot of the year as they've kind of gone through these 2 quarters that are very different in the makeup.
I will just say that one of my, in addition to the tech rebound and the first to worst I talked about, the thing that surprised me the most in the second quarter was the boring old diversification and how it actually matters, right? So again, here's the broken record, because diversification is such a boring topic, right? It just is, but it's so important for people to understand. It's like saying, talking about fuel economy is so boring, but it's so important to, how well your car is running or how much gas you're saving on a trip or anything like that. I'm a boat owner, so you want to talk about You want to talk about like gas efficiency, right? I've got this gauge on my boat that tells me how many gallons an hour I'm burning. And if I'm going full speed, I'm burning 50 gallons an hour of fuel. Like, that's just
Yeah,
crazy. Because
it
on the
is.
water, you pay $5 for it, right?
And
So
it's kind of like a
anyway,
portfolio. If you're going full speed, you might be burning your resources way quicker if you're not paying attention to
yeah.
what it means to actually, slow down when you can be more fuel efficient, to your point.
Mm-hmm. Yeah, exactly. But okay. So anyway, um, the diversification really mattering. I mean, because here's again the broken record. Like, just nothing leads forever. Trees just don't keep growing to the sky, and we saw that concept play out during the first half of 2026. I'll start off with emerging markets and international stocks outperforming U.S. equities. So the ticker IEMG, which is the emerging markets, up
Hmm.
24.2% through the first half. And then the small and mid cap stocks outperforming their large counterparts, with IWM, which is small cap, up 22.6, and MDY, which is mid cap stocks, up 17.2%. And then what was really interesting too was the value stocks outperforming the growth names. So we saw IWD, which is the ETF that tracks the value stock, the large cap value stocks, up 16.1%, versus the IWM, which is the growth names, was only up 5.1%. And that's while the S&P 500 was up 10.1%. So almost exactly in the middle, the S&P 500. So the value stocks just really, really doing well versus the growth names. And most people haven't been all, pounding the table on value stocks for the past few years, because we've been doing nothing but talking about the Mag 7. So, and speaking of that, that group was actually down. That's that minus 2.5% I was telling you about
Hmm.
at the end of the quarter. And then 6 calendar days later, it's back positive. But, I just want to, I think the thing that shouldn't surprise me was that, hey, diversification still matters. And, this, again, that small cap performance, I mean, entering 2026, okay, the US small caps, as measured by the Russell 2000, okay, has trailed the US large cap S&P 500 index for 5 consecutive years. Okay. Then, just inside the first 6 months of 2026, when I barely have my Christmas tree put away, we see this reverse, right? Where small caps have gained over 22%. And that, by the way, that was the best first half performance for the Russell 2000 since 1991. You know what I was doing in 1991? Getting ready to deploy to the Desert Shield Desert Storm. I mean, that's how long ago it's
I
been
wasn't
since
even
that
born yet
performance.
at that point, honestly, Dave. It's got
I
me
mean,
beat by a
like,
year.
yeah, I was like 23 years old. Anyway, that was the best first half performance since 1991. I mean, that's a pretty damn long time. And, and with that 12% spread over the large cap index, you know, we've seen the biggest small cap outperformance for the first half since 2001. Again, 2001 was like 9/11. So,
Yeah.
it's been a long time since we've seen this sort of outperformance, either on a whole basis or just a spread over large cap or any of those things. And, kind of flew under the radar. Nobody's really talking about it.
And I think you can approach diversification two ways, right? I think it's really important. You can choose which way you want to approach it, because
Right.
so many people have been calling for value stocks to outperform growth and small cap to outperform for, I'm going to say, a decade.
Yeah.
Now, it took basically until now, basically 2026, for that to happen. So, yes, you could have been in those saying every year diversification, diversification, which is fine if you're okay understanding that diversification usually means you have something that isn't quite keeping up with the better performing part of your portfolio. Because you're not
Right.
diversified if everything is moving in tandem. You need things
Mhm.
being moving differently. International, to your point, is another example. It really hasn't been until 2025 and 2026 now, where international emerging markets have done better than the US markets.
Right.
Diversification was, you can take a more buy and hold approach, which I actually think can be a completely reasonable solution, because at some point you're going to see the benefits as things catch up, and you don't want to have to try and predict when that's going to happen. You want to know that you're going to be in that. So through better or worse, you're going to hold stuff that maybe again is moving differently as other parts of your portfolio. That's one way.
Exactly.
I
Hmm.
think the second way you can do diversification is if you're able to take a very active approach and look at the data. Wait till you start seeing some of the momentum into these sectors and then move towards them. move towards them to be allocated to the parts of the market that are showing strength when they show strength, not in anticipation of it, because you're never going to be able to predict when that strength really holds. You're going to need a data-driven approach to tell you, we have momentum here. Let's try and capture this.
Exactly. Okay, here's a new analogy for you. Ready?
I love new Dave analogies.
Here it is. Diversification is the everything bagel of the bagel world. Okay. It's got a little bit of everything, right?
Correct.
Now,
as the name implies.
Some people just like poppy seed. Some people just like onion. Some people just like plain. Some people, whatever it is, but everybody loves the everything bagel. And that's diversification.
It is. It works pretty well. I'll give you that. Yeah. It does. Especially, again, on Long Island. I had to learn how to say bagel correctly. So, but that's the point, is there's a little bit of something for everyone.
Yeah. And again, I think we're going to make that a tagline now.
There's a little bit of diversification.
Everything bagel of wealth management, right?
Yeah. Again, it means so much to client portfolios, because then when you get an overly concentrated market that is going through these rotations, it's not predicting when it's going to happen. Like I said, it's being ready to be there already. And we have portfolios like that. We have global portfolios that are kind of permanently global, meaning we're always going to have exposure to international stocks. And within those markets, again, we're going to be trying to do better by being allocated to the right parts of it and avoiding those underperformers. So, for international stocks, that means not necessarily just buying access to all the countries out there besides the US, but really looking at a country-specific markets to see where the strength is, right? And navigating. That's all it is diversification means, again, to your point, it's the everything bagel. You have a little bit of it, but again, let's say the cream cheese of it, maybe. I'll try my own analogy here. Let's see how it goes. But the cream cheese, if you want scallion cream cheese, because that's what sounds good, get scallion cream cheese. Be allocated. You want vegetable, get veggie. You want plain. You can choose what you put on your everything bagel to really maximize the potential of it.
Right.
But again, you still get the everything bagel because it's got exposure, diversification to a bunch of different flavors. Investing's the same way.
Not bad, Nate. I'm rubbing off on you. It's great.
You got to be able to go on the fly with the analogies, because there's always a good one out there. You just got to find it.
I was talking about, I was recently having a conversation with somebody where I use the analogy. I'm like, no, this is like your kitchen faucet where you have a hot handle and a cold handle and you can adjust them each. Like, it's not just like one lever that turns the water on. Okay. Anyway, I won't go there, but
no, it makes sense.
Listen, I want to know what your current thoughts are on inflation.
Ooh, I love this. See, this is where, again, the macro, my degree's in economics, and this is where economics, I think, this is where I love to shine, because inflation is fascinating right now, because a lot of people think inflation's about to reaccelerate. I see inflation getting back to more normal, I think, quicker than most people, for a few reasons. First off, the market expects that to happen. Now, I'm not saying the market's perfect, but a key thing when it comes to inflation is not what inflation is currently, it's where inflation expectations are. And here's why. Consumers adjust their behavior based on where they think inflation is going, not where it currently is. If people think prices are going to get cheaper in the future, they may delay some of their purchases in hopes of that happening. Vice versa. If they think prices are going to keep going up, they're going to spend to hopefully get in front of that. What's weird is that's a counter-cyclical behavior, meaning if you're spending a lot of money and a lot of spending is going on in the economy, that naturally pushes inflation higher. That's where you get into that weird cycle of all of a sudden now prices are going up, people are spending more, which pushes prices higher, which causes people to spend more, and you're in that circle. Well, right now, inflation expectations at the height of the Iran conflict, when people were the most scared about inflation, peaked out at about 2.7% per year over the next 5 years. They're down to 2.3 as the ceasefire is held. Now, we're, again, recording on the 8th. There's been some new developments. It seems like conflict may be coming up again. But either way, I think you're seeing consumers expect inflation to come down, and that's going to lead to different behaviors. It's going to lead to less spending, which naturally will help inflation come down. And if inflation's coming down, yes, it's coming down at the pump when you fill up your car, but that's really not the important thing. Those prices that you pay for gasoline bleed through every part of the economy, from flights that you might take for vacation, for business purposes, business spending. If you want to fly in consultants or fly out your team to go do research for future growth, it's really expensive right now, very expensive. And so that hurts business. Not to mention when you're transporting goods, whether it's your food that's coming in that needs to be transported, or, you're a business owner and you need to be shipping your products out to either warehouses. All of the higher fuel costs that you saw as a result of the war have not fully bled through the system. So there is going to be elevated inflation in the future, I think, because most people are locking in fuel prices ahead of time. All those big airline carriers, they know what they're paying for their jet fuel for the next handful of months. Same thing with shipments coming out. I think that's where you're going to see kind of that work through of, yes, inflation in the short term, but long term, people expect as gas prices come down to things to normalize. And expectations are important.
It's funny because it drives so much of the behavior, and you've got, the TV is just full of anybody who's got an opinion that's never held accountable. Like, you know who Harry Dent is, right? I'm going to explain who he is, but like he's constantly calling for, market sell-offs, writing books on all this kind of stuff. And back in April, he made this comment about the everything bubble and how it was going to pop, right? And at that time, he said, buy the SQQQ, which is the 3 times inverse of the QQQ and the TLT. It will increase in value 3 times however much the QQQ goes down. Right.
It goes down 1%. If the index goes down 1%, your investment's going up 3, roughly.
3. Exactly. Right. So it's a 3 times inverse the direction of the QQQ. And he said to buy the TLTs, right? Okay. Since then, I mean, stocks have staged this just incredible historic rally, right? The TLT, slightly negative, right? And the SQQQ is down like over 30%. The guy could have bought rotting banana peels and made more money than that call, So like, here's what I'm coming back to. You just have to look at things and say, am I in this for the long haul or am I not? And I can go back and tell you, since I became employed and started contributing to like retirement funds. So I'm going to go back and say, okay, I'm going to use my graduation from college in 1990. Okay. So, what's happened since 1990? Okay. I'm going to backdate a little bit. I'm going to start with Black Monday in 87, right? You had Black Monday, then, the AIDS epidemic, and then Chernobyl, and then the tech bubble, and then Asian contango, and you had the great financial crisis, and then the famous taper tantrum that we went through. And then you had, the European debt crisis. Then you had, Russia invades Ukraine, COVID, Hamas attacking Israel, war in Iran, all of these things. You could have pointed to each one of those things and said, oh my God, this is the beginning of the end. This is it. And we're always being told that these big geopolitical events are always going to cause a problem. Yet, the amount of money that has been made by just simple investing in the stock market since the day I graduated from college, it's crazy good. So I just caution people when they think about things like, we can talk about inflation, great. You can talk about Iran, you can talk about oil prices, you can talk about all this other stuff. But at the end of the day, if you're a long-term investor, those topics are interesting to know and talk about just from a current events perspective, but you really shouldn't be, having any sort of investment philosophy revolving around those things. And I'll even carry this into politics, right? The Dow is above 53,000, roughly. Okay. I think it's still even today with a sell-off, it's above 53,000, right? And the amount of times that I've heard that Washington and political parties and everything is going to ruin the bull market. And I just go back in time and think, my God, I mean, like, you can look at red or blue politics in power. It doesn't matter. So people who are getting all worked up about like, oh my God, I think this current administration is going to do this, or the past administration was going to do that, whatever it is, like, you got to ignore all that noise. It doesn't amount to anything.
Yeah, and I think here I'll get our listeners ready for the noise that I think you're going to hear before you even hear the political stuff. It is going to be inflation related, because I don't think food prices have peaked yet. like what we talked about with inflation kind of working through the system with all those costs. Well, the other big thing with the Strait of Hormuz was fertilizer. A third of the world's fertilizer that is transported by the sea over the seas goes through that strait. And if you look at it, prices of that is just being felt by the farmers, which is going to affect the political environment going forward. Because back in April, like you just talked about with the call, the market call there, but back in April, 70% of farmers responded to a Farm Bureau survey saying that they can't afford the fertilizer they need. And there's a lot of talk of lower crop yields because not only fertilizer, but bad weather across various parts of the world. So whether you're in, the South, whether you're in the Corn Belt and the Midwest, whether it's drought, freeze, flooding, like that's going to have a real effect. And you're going to be hearing about inflation has never been worse. Like the market is going to tank. People can't afford any more food. Like you're going to hear all that noise, but you got to be that long-term investor. Like you said, Dave, like it's going to be painful, but long-term, as I get back to kind of the expectations is all these are going to be temporary shocks that the market is just going to have to work through. So be prepared to hear all the noise. It's only going to get worse in the future in some ways because it is a political year, a midterm year. So all that, what I just talked about, food prices, with gas prices, with inflation, like that's going to be a big piece of the talking points as we go into November. It's going to sound scary, but that doesn't mean it is scary based on when you, again, to just bring the conversation full circle, you see companies making all-time highs at a high percentage.
Yeah.
You see a lot of earnings growth that is justifying the valuations in the market, if you ask me. So again, it's look at the data to help cut through the noise. It's really as simple as that.
Well, that's great. I think that kind of wraps it up for today, don't you think?
Yeah, I mean, I think again we always cover a lot of grounds. I think we did a good job not going down too many rabbit holes. Once again, I'll say Fairweather fan Nate here is very happy to be a New York resident at this time of year. So hopefully it'll only go up.
Yeah, exactly.
Go Knicks. Yeah, right. So, and I always like to let listeners know, we did our quarterly review today, but we always do AMA episodes. So ask Monument anything. So leave us your questions in a comment on any of our social media channels. You can email us at offthewall@monumentwm.com. We'll love the questions and we'll make sure to incorporate them as we kind of move forward throughout the second half of the year. So
yeah, I'm looking forward to answering the question that came in the other day about SpaceX saying like, so when are you going to be right on the call that you made in the podcast? I'm like, hey man, we're not wrong. Okay. So like that thing's trading right around where the offering was, but we'll see what happens. But that was a question that came in the other day. Maybe we'll jump on that one next time.
Don't worry. We'll be held accountable for our SpaceX podcast previously. So
yeah. Well, and where is SpaceX is right now, it's down 2.75% today. It's trading at 145.
So it's below, it's a launch price of 150. So we're moving in the right direction. All right. Well, don't spoil it for listeners.
No, I'm not going to spoil the fun, right? Because listen, when we record AMA, it could be 200, it could be 100. Who knows?
Yep. So we'll find out next time.
Tune in to find out. Right. Exactly.
Yeah.
Right, man.
Thank you for everyone for tuning in. Make sure to hit the subscribe, follow button so you never miss an episode. We'll see you next time.
Yeah. Do all those things. Do all the things.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.